Now let's discuss the main types of U.S. Treasury securities and how they work. The first type is Treasury bills, or T-bills. Treasury bills, which are commonly called T-bills, are short-term bonds that mature within 1 year or less from their date of issuance. Authorized sellers sell T-bills with maturities of 4, 13, 26, and 52 weeks. Bankers call them as the 1, 3, 6, and 12 months T-bills, respectively. The first three kinds become available through auction once a week. They auction the 52-week bills every 4 weeks. Now, check this out. Since the maturities on the Treasury bills are shorter, they offer lower yields than Treasury notes or bonds. The next thing I'd like to discuss is Treasury notes, or T-notes. Treasury notes, also known as T-notes for short, they are intermediate-term bonds from the U.S. Treasury. They commonly mature in 2, 3, 5, or 10 years. Holders of T-notes can expect to receive semi-annual interest payments at fixed coupon rates. Before 1984, the U.S. Treasury was issuing callable T-notes, which meant that the Treasury can repurchase the notes under certain circumstances. T-notes usually have a $1,000 face value, but those with 2 or 3 year maturities have $5,000 face values. The third type is probably the most popular, Treasury bonds. Treasury bonds are the long-term bonds from the U.S. Treasury. Traders commonly refer to them as T-bonds. They normally have a face value of $1,000, and interest payment comes semi-annually. The government issues them to help fund shortfalls in the federal budget, regulate the nation's money supply, and carry out a U.S. monetary policy. As a typical bond issuer, the U.S. Treasury looks at market risks and return requirements to prudently and effectively raise capital. This is the reason why over the years, the Treasury have been coming out with several types of Treasury securities, such as T-bills, T-notes, T-bonds, strips, and TIPS, to name some of them. U.S. savings bonds are another type you should pay attention to. Savings bonds come in the traditional paper or the modern electric form. However, beginning in 2012, financial institutions stopped selling the paper form. Investors may purchase them from most financial institutions or through www.treasurydirect.gov. U.S. citizens, U.S. residents, and U.S. government employees, regardless of citizenship, may be able to buy and own savings bonds. The good thing here is, even minors can own savings bonds. Let's dig a little deeper. Authorized sellers offer the paper EE bonds at 50% of face value, which means that a purchaser will pay only $50 to get a $100 bond. The bond only becomes worth its face value of $100 when it matures. On the other hand, sellers sell electronic EE bonds at face value. So if you want to buy a $50 bond, you have to pay $50 for it. You can purchase electronic EE bonds in any amount as long as they are over $25. Now, let's go to I bonds. If you want to purchase I bonds, then you need to understand that you have to pay its face value. So, if you want a $100 bond, you have to pay $100. Similar to the EE bonds, the minimum you can invest is $25, and you can buy any amount over $25. When it comes to proper savings bonds, investors can only purchase in $50, $75, $100, $200, $500, $1,000, $5,000, and $10,000 increments. They may buy up to $30,000 worth of savings bonds per year. Here's how it works. When a bond matures, the holder will receive the face value of the bond plus the accrued interest. Holders cannot redeem them for the first 12 months they are outstanding. If a holder redeems it within the first 5 years, they will forfeit the last 3 months of interest as a penalty. In 1997, the U.S. Treasury came out with notes and bonds in a new form that would protect the holders from the effects of inflation. They call these inflation-indexed securities as Treasury Inflation Protected Securities, or TIPS. Basically, the Treasury Department uses the Consumer Price Index, the CPI, as a guide to adjust the value of the principal to reflect the effects of inflation. This instrument gets a fixed rate of interest payment 2 times a year based on the adjusted principal. The final adjustment comes out at maturity. If inflation has increased the value of the principal, then the investor would receive the higher adjusted amount back. However, in a case when inflation has decreased the value, the investor will receive the original face amount of the security. Let's look at an example of how inflation index securities work. Please note that this simplified example is for illustration only and does not necessarily reflect current market conditions. So let's say, at the beginning of January, you invest $2,000 in a new 10-year inflation index note. The note states a 3% annualized interest, and it is payable semi-annually. In the middle of the year, the CPI indicates an inflation rate of 2% for the first 6 months. What happens then is that they will adjust your principal upward to $2,040, $2,000 times 102%, and your resulting interest payment would be $30.60, which is $2,040 times 3% times 6/12 for the interest earned for the first 6 months. At year end, the index indicates that the inflation has risen to 3%. This will bring the value of your principal up to $2,060. Under this amount, your second interest payment would be $30.90, $2,060 times 3% times 6/12. Since these instruments already help cushion inflationary impacts, they offer lower interest rates compared to other U.S. securities of similar maturities, but without the inflation protection. The next type I would like to discuss is separate trading of registered interest and principal securities, or STRIPS. Now, I know the feeling. Any product with that long of a name would have to be a complicated one. But STRIPS are fairly simple as an instrument. They are basically the same traditional bonds, but banks just sell the bond principal and bond coupons separately. The U.S. government does not issue the STRIPS directly to investors the way they sell Treasury securities or savings bonds. Instead, it is the financial institutions such as investment banks who create the STRIPS. They purchase conventional Treasury securities, then strip the interest payments away from the principal. They then sell the principal and interest to investors as separate securities with separate CUSIP numbers. Nevertheless, the U.S. government will still back the STRIPS with its full faith and credit, notwithstanding they have disassembled the original security. Banks sell the principal part of a discount so the investor can earn the face value when the bond matures later. Many other countries also sell, issue, and back STRIPS. Last but not least is the floating rate note, the FRNs, which is also the youngest tool in the U.S. Treasury scope. The U.S. Treasury started issuing floating rate notes, or FRNs, in January of 2014. They are basically debt securities that pay interest rates quarterly until they mature. They normally have a term of 2 years. The reason for the name is that interest payment of FRNs change or float depending on discount rates in auctions of 13-week T-bills. The U.S. Treasury holds an auction for FRNs, so the results of the auction will determine the price of the instrument. It could be greater than, less than, or the same as its face value. However, when the notes mature, the holder gets paid the face value of the FRN. Its interest rate varies, however, because it depends on the highest accepted discount rate of the most recent 13-week Treasury bill, so it changes each week. On the other hand, the spread is the highest accepted discount margin in the auction where they first offered it. It will remain the same for the entire life of the note. Should an investor want to bid for an FRN, he could do it in 2 categories: non-competitive and competitive. Non-competitive investors have to bid online through an account on the website Treasury Direct. Investors can use also an intermediary such as a bank or a broker. The U.S. Treasury holds the FRN auction every month, but they issue original FRNs in January, April, July, and October. There are also reopenings, when additional amounts of previously issued securities become available. This happens in the other months. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Are you considering U.S. Treasuries as an investment? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial education videos.